Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me. Can you hear me? Tell me, please. All right, now, so in the last class, we have discussed some basics, regulatory environment, and today's topic is audit methodologies, audit strategy, audit plan, and ISA 315. Very important topics today we have to discuss, as I said in the last class. So let us connect to the iPad and proceed with the discussion. Yes, of the topics. So students, audit methodologies. Methodologies are basically direction to be chosen. For example, you have to reach from Mauritius to UK. What are the directions available? You take flight, some direct flight, okay? You take some via ship, you take a flight from Mauritius to Turkey, and then from ship or by road to UK. Multiple directions are available. Even you can make more combos. So you have multiple options, directions available to move from Mauritius to UK. And in order to do that, students, you have to choose one out of these options. Similarly, this is audit report has to be issued. And for that, work has to be done on financial statement. And here is the audit planning stage. From planning stage, you have to make a plan, choose directions available. One direction or combination of directions to be able to give audit reports. These directions are called methodologies, audit methodologies. These directions are called audit methodologies. So audit methodologies are multiple methodologies available. which are also called audit approaches. Approach is available. So the first methodology or first approach to audit, that is risk-based approach. The first approach to audit, that is very good approach, that is called risk-based approach. Now, what is risk-based approach or risk-based methodology? Since auditor has to report on financial statements, an auditor has to perform work on financial statements, an auditor has to detect material misstatements in the financial statements. This is what auditor has to do. So what auditor can do is, auditor can identify those areas of financial statements which have high risk of material misstatement, where chances of occurrence of material misstatements are high. So at the planning stage, you do that you identify those areas where misstatement chances are high. And then secondly, you direct audit effort towards those areas. For example, let us talk about it a bit in detail. That when auditor is auditing the financial statements, there are, for example, 2-3 items available in front of him.
First one is, for example, that is rent expense. Then is wages and salaries, and then is deferred tax. Now you tell me, out of these three, which has a highest chance that it may not have been recorded correctly, which has the highest risk of material misstatement? Out of these three, tell me, what do you think? Yes, students, what do you think? Which of these have highest risk of material misstatement? Now, your answer is correct. The point is deferred tax. The reason is deferred tax has high risk of judgment, complex item as well. So identify those areas. You identified that it has high risk of material misstatement. So more time should be spent on its audit than other items. The question is here. This is called risk-based approach. And this is the approach which is recommended by ISA's, International Standards on Auditing. This is the approach which is recommended by ISAs. Now, next. The next point is, the second approach is, that is system audit, system-based approach, or system audit approach. System audit is that you just go, since controls of the company are used to prepare financial statements, to record items, and hence report in financial statements. Controls are used. So controls. So what do you do? So the check or test controls of company for effectiveness. Now, two possibilities are there. They are effective or they are ineffective. Controls are strong or controls are weak. Two possibilities are there. If controls are ineffective, it means detailed substantive tests. Substantive tests are tests on financial statements by auditor. Substantive tests. Let me write it a bit more clearly. On financial statements. Substantive tests are tests by auditor on financial statements to detect misstatements. If they're effective, it means less detailed substantive tests required on financial statements. This is system audit approach. Next. The next point is the next approach is, that is balance sheet approach. So this approach talks about balance sheet means financial position, statement of financial position, that all transactions are closed in the accounts balances and account balances are present in the balance sheet. So start with balance sheet items and test all the transaction and everything affecting them. If balance sheet items are verified, everything is verified. This is called balance sheet approach. Yes. Then is transaction cycle approach. Transaction cycle approach. Transaction cycle approach. What is transaction cycle approach? Transaction cycle approach means that we have to test the transactions. The transactions, verify the transactions. Whatever is happening, and automatically everything is verified. Verify the transactions means inverse of balance sheet approach. When transactions are verified, everything else is verified. They say verify balance sheet items, everything is verified. So it's just like that direction, nothing else. And the next is directional testing. Directional testing. What is directional testing? Directional testing is that it is a part of detailed substantive tests, means tests on financial statements. Basically, they say that one is accounting record, and financial statements, and the other is source documents or physical evidence. Source documents. What are source documents? GDN, GRN, invoices, etc. Credit notes, purchase invoice, sale invoice. So basically, directional test. The first test is which is called as tracing as well. Tracing or test to detect omission or understatement. Now, now, so students, what is this test? Test to detect omission or understatement. This is start here and verified here. Starts here and verified through accounting record or financial statement. Starts outside accounting record, starts outside financial statement. Here means outside financial statements, and verified through financial statement accounting record. For example, a sample of GDN, which are for sales, good dispatch note. We pick a sample of GDN and we take them and verify through financial statements and whether they have been recorded in the sales or not. If they're recorded there, it means it is recorded correct. If not recorded, misstatement, understatement identified. It means it is omitted. Is it clear? This test is clear? How it is verifying understatement or omission? Yes, students, tell me, is it clear? Next, the next is accounting record and financial statement. So the next is test to detect overstatement. It is also called vouching. That something is recorded in financial statement, but that didn't occur. That does not actually happen. So something is overstated. So it starts here and verifies here. You see, direction is inverse here and verified through outside accounting records. For example, assets have been recorded, property, plant, equipment in financial statements. Okay, show me where they are. Physically show me, physical evidence. They are unable to show me. It means it is overstated. This is called directional testing. Test to discover omission and test to discover overstatement. Some, for example, they have recorded purchases, okay, in financial statement, in accounting record. Show me where there are purchase invoices, good receive note. If they show me, well and good. If they're unable to show me, it is overstated. Now, next. Students, directional testing is based on double entry system, accounting system. Tell me one thing, all of you have got notes volume 1 or not? Notes volume 1, you have obtained, all of you? Tell me please. Okay, let me show you where they are. Let me show you where they are. You will see here, come to the website. Come here, December 2022. AAA, move to AAA, batch A. Here it is. Come to curriculum. Oh, not uploaded here. Why? Let me text the coordinator. Why they have not sent it? You will find it here below course plan. They will upload in few minutes. No, it is beyond digestible for me as well. That's why they have not uploaded it yet. Now, so it is based on double entry accounting system. What is double entry accounting system? That for every debit, there is a credit. For every debit, there is a credit. For example, they say if an asset is overstated and they have done debit, an asset is overstated. Something debited more, overstated. So in order to compensate that, either another asset is understated, to compensate it, or a liability is overstated to compensate that, or some expense understated, or some income overstated to compensate that. Means error does not come alone. They exist in the form of pair. And similarly, this is called double entry system. Now, next point. So this audit methodologies are done. Now we will proceed towards, let me take you to the notes. Audit methodologies are here. I have discussed risk-based approach. I have discussed system audit, balance sheet, transaction cycle, and directional test. You see, they say one is overstated, so then one of these will happen. If it is understated, one of these will happen, and so on. Yes, it will happen. Now, let us proceed towards next topic, audit strategy and audit plan. Then audit strategy and audit plan, then materiality I will discuss, then ISA 315. A wonderful day today is. So what is audit strategy? Let us where I started. Here, trip from Mauritius to UK. Students, you have to choose a direction. A methodology from Mauritius to UK based on multiple factors. The factors are, of course, the factors will consider the distance How much is the distance? Which is basically says scope. How much is the work? You have to choose. If distance is 1,000 kilometers or 10,000 kilometers, how much it is? Scope. Second is and the second point is resources available. Money. Because every direction has a cost, different cost. Time available. You have time available 1 day. You cannot travel by ship. Yes, risk involved, risk assessment. And based on all these, you will choose one direction. This is called strategy formulation. This is called strategy. So what is audit strategy? Audit strategy, come here. Audit strategy is basically how the audit is to be carried out. I will say scope, you can note down audit strategy, timing, and direction of audit. That characteristics, scope of work. How much work you have to do. What is the outcome they want? And what is the time available? What is the risk level assessed before accepting audit? We discussed it in the last class. If you remember, know your client, risk assessment, need and resources. What type of resources required? When? How much available? And then deciding the direction of audit. Based on all that, you need to decide it. This is called audit strategy. This is called audit strategy. Students' notes have been uploaded there. They said me, let me refresh it. They said they have uploaded the notes here. Just received the text. Curriculum, yes, here it is, volume 1. You can download it now. Click it there in the preview. Yes, and here on this arrow, and then it will be downloaded in your system. Okay. So audit strategy and audit plan. What the audit plan actually is. Student, audit plan is the detailed implementation of strategy. You have chosen, okay, about the strategy. You have chosen, come here. For example, you choose on, okay, I will take flight. Then plan will be accordingly. That how I will go to the airport, at what time I will depart, which flight I will take, our timing, Okay, which airline, how I will board, which luggage I have to take, how I will, when I will land, how I have to make arrangements further. That is called plan. Plan is further. If you choose this one, your planning will be different. If you choose this one, planning will be different. So similarly, audit strategy is whatever strategy you choose, plan will change. Specific procedure to implement strategy. And tell the risk assessment procedures, audit procedures, or any other work to be performed. Yes, any other work to be performed. This is called audit plan. So then it is done. The next topic is materiality. Then I will come back to ISA 315. Is it clear so far? Tell me. I need response from everyone. Dear, is it clear so far? Tell me, please. Good. Now, next. So the next is I will go to the materiality topic. Then I'll come back to the ISA 315, and if we have time, I will shift to the audit risk as well. So that in the next class, we can proceed with the past exam question. Yes, please. And this is what we are covering today. You have to prepare at home very well. So materiality. Let us discuss materiality. What is materiality? Materiality is basically relative significance of information in a particular context. Relative significance. Relative significance. Now, listen, tell me, 500,000 rupees, is it a significant amount or small amount? For me, it is significant. For Emirates Airline, not significant. Small amount. So that's a relative significance. COVID-19 information, it was quite significant in the first wave. But now it is not that much significant because things have been a bit diluted. relative significance in a particular context. Context change, significance may not be the same. Now, so materiality we are talking about. So students, when we talk about materiality, why we are studying materiality basically? If we see audit report wording, in audit report, auditor says, in our opinion, financial statements of company give true and fair view of company affairs in all material respects. In all material respects, that financial statements are showing the company's actual affairs in significant aspects. Insignificant effects we ignore. Things may be different in the company and what is being shown in financial statements. There may be insignificant difference, but significantly they are the same. So what is significant amount? What is material amount? What is material information? We need to learn that. How auditor decides about materiality. So students, at planning, we are at planning stage of audit. At planning stage of audit, auditor decides an amount which is material for financial statements of company. Which is material for financial statement of company. How auditor decides? And why auditor decides? Now two questions arise. How auditor decides and why auditor decides? How auditor decides that materiality and why auditor decides? Students, auditor decides this materiality at financial statement for financial statement as a whole by using professional judgment. His judgment, by considering facts, company circumstances, company operations level, etc., a number of other factors. But there are certain benchmarks available. Certain benchmarks available, which are most commonly used. And for P7, AAA, we need to memorize those benchmarks. What they are? That is 0.5% of sales, 1% of or assets, or 5% of profits. They are material. They are material. two financial statements. Any one of these. You can calculate. This is just for reference of AAA. Now, the next question is, why auditor decides it? This materiality level. For example, he calculates an amount, 1% of assets or 0.5% of sale. For example, it is any one of his, 500,000. Now, what is the purpose? What is the purpose to decide this amount? The purpose is auditor has to plan and perform audit work on financial statement to detect misstatement which are material to financial statements, individually material or when aggregated, which are individual misstatement which are equal to 500,000. Auditor need to detect that. Misstatement is something which is not recorded at correct amount, correct way, correct place. Individually, 500,000 are those small misstatements. When they are aggregated, they become equal to this 500,000. This is the purpose. Is it clear to you people so far? Tell me. Is it clear so far? All right. In other words, no material misstatement should go undetected. No material misstatement, individual or when aggregated. No individual material misstatement, whether it is individual or when aggregated, it should go undetected. No material misstatement should go undetected. This is the purpose. Now, so what does auditor do? Auditor further digs in deep to achieve this target, because this 500,000, which is called materiality at financial statement level, it is also called overall materiality. Since it is being set at planning stage of audit, that's why it is also called planning materiality. Why planning materiality? Because it is being decided at planning stage of audit. Now, so in order to achieve this 500,000 is red line, it should not be crossed. Means all misstatements individually or those small misstatements, when aggregated, they are equal to this. They should be detected by auditor. Now, next. So students, in order to achieve the same continuing materiality, auditor overall materiality is 500,000. Auditor decides further lower materiality levels for high risk areas of financial statements. Lower materiality level to test those areas more. He reduces the materiality. For example, he thinks that deferred tax is a highly risk area. So for its materiality level is 100,000. For example, sales is high risk area. Okay, its materiality level is 300,000, lower than 500,000. Non-current asset is not that high, but it is high. Okay, 450,000. You got my point? He is establishing further lower materiality levels. Lower materiality levels, so this is called performance materiality. This is called performance materiality. Note it down. Now, come here. Performance materiality. Let me show you where it is. Materiality. Here is the materiality topic. Yes. It is the amount or amount set less than materiality as a whole. What is the purpose? To reduce to accept and the probability that aggregate of uncorrected, undetected misstatement exceed materiality as a whole. Auditor can set different materiality levels for different areas according to risk involved. So low materiality level for high risky areas. Judgment. Now, so students, okay, they say these are rules to set materialities, but it is judgment. Materiality is judgmental. Defined written rules may not always hold true. You have to judge. Okay, materiality, you can note down this. Materiality is of two types. One is called, okay, not here, come here. Materiality is of two types. One is called quantitative materiality. The other is called qualitative materiality. Qualitative. So quantitative materiality is materiality by amount. That amount involved is material. And qualitative materiality, nature of, and we have been talking about quantitative so far, 5%, 2% amounts. Nature of information is immaterial, not amount. Not amount. Not amount. What does it mean? Nature of information is material, not amount. The meaning is quite clear. That qualitative materiality, when we talk about it, so basically, sometimes, for example, a company is penalized by, for violation of law, fine is 25,000. Not big amount. 25,000 is not big for company, but nature, violation of law is important. So nature is important, not amount involved. So students, materiality is also covered. So some things are important by nature, qualitatively, not amount involved. Now students, we have only one topic left for today's lecture. That is ISA 315, but I will talk about it. And if we have time, I will move to the audit risk as well. Okay, we have time, I think. So normal time of a lecture will be 2.5 hours, 2.5 hours, remember. Okay, so but I'll be taking a break now, 10 minutes break. After break, we will be back, and ISA 315 will be our target for today. So see you after break.
Yes, everyone now. Our next topic is ISA 315. The point is, students, we discussed up in the morning, means the start of the lecture, there is a risk-based audit approach. Risk-based audit approach. So ISA 315, you need not to memorize the number. It is basically identifying. Let me show you from the notes, leave it instead of writing it here. Assessing the risk of material misstatement in financial statement. We said in the risk-based approach, auditor identifies risky areas of financial statement, those areas where chances of misstatements are high. We discussed that, and then directs audit effort towards those areas.
Testing safe areas of financial statement. Instead of testing safe areas of financial statements, he tests and direct audit effort towards those risky areas. So the first step was identify those areas where misstatements are more likely to be present. So ISA 315 is basically identifying risk of material misstatements by that auditor. This is the purpose. The purpose is here. And how it has to be achieved, it is here. Understanding the entity. That auditor is coming to the company and he will understand the company, its industry, its areas, the nature of business, objectives of the business, how the financial statements are prepared, control system. And then during that understanding, auditor will identify those areas which are most likely to be misstated. For example, auditor asking that, what are your future plans? They say, we are going to be listed. So understanding of they are going to be listed. So immediately when a company is going to be listed, there is a high risk that they may have manipulated financial statements. Now, so students, I have just given you one example. They say, I ask, who is the finance director? They say, oh, our finance director left 2 months ago before the year end. So immediately, okay, 2 months, last month, finance director was not there. So more chances of misstatements are there in last 2 months. Immediately link. Students, do you note these examples which I give or not? Tell me, do you note down some hints or not? Tell me. Now, so now how auditor understanding inquiries, asking the management. I am giving you example. Auditor goes and observes the business, how it is going on. Inspect the documents, contracts, board minutes, management meeting minutes, correspondence, letters, and performs analytical. What are analytical procedures? We are going to talk about that. Now, students, significant risk. Student, now it has become important because now in exam you will get mark for it. And when you are discussing risk of material misstatement, you should discuss significant risk first. Those risks where fraud chances are there. Judgment is involved, high judgment, high is the risk. Unusual transaction, unusual. Company has given loan to a director or given loan to another company. Unusual, although company is not doing business of loan. Related party transaction, complex transaction, complex amounts. So significant risk. You should know what are the significant risks of material misstatements. Now, student, auditor understand the entity through analytical procedures as well. How? What are analytical procedures? Student, analytical procedures are those procedures. The name tells analytical, analysis, comparisons, trends study, and trying to link where there is unusual change. So plausible relation, plausible means valid relationship. They are performed at 3 stages of audit. We are at risk assessment stage right now. So they are performed in these assignments: business risk, reviews, assurance engagement, PFI. What they are: reasonableness, judgment, comparisons, this year information with the last year. This year information with the last year. Sales with the last year. Cost of sale to the last year. Salaries to the last year. If GP margin, NP margin. ROS, current ratio, quick ratio, receivable days, payable days. And we try to figure out where there is unusual change that may be misstated. That may be misstated. Now, next. So, student, the point is, I repeat my words. I repeat my words. Analytical procedure is basically comparison of the ratios of this year with the last year. This year, actual financial statement with the last year. and we identify unusual change. I'm not saying change, unusual change. Change which is beyond the expectation, beyond the reasonableness, which is not in line with the other trends. And we say it may be misstated. For example, let us discuss it with the example. I will type it here. The examples I will be typing here. Just a minute, please. Here we are, for example. GP margin increasing. GP margin and net profit margin. Significant increase from the last year. Why? There is risk of misstatement. Management may have manipulated. Either may have overstated sales. You can note down this explanation. Either they may have inflated sales, incomes, or may have understated some expenses. To misstatement, risk of material misstatement. Significant decrease from last year. Now, going concern problem might be there, which may not have been disclosed. Company survival may be difficult, and any uncertainty related to going concern may not have disclosed. So this is misstatement. Yes. Now, next. The next point is GP margin increasing and net profit margin decreasing. Now, this is inconsistent trend. And yes, this is inconsistent trend. It means either some costs may have been omitted or may have been misclassified. Some costs may have been omitted and some may have been misclassified. Now, next is receivable days. Increasing from previous year. So, what is the issue? What can be misstated? In the risk of material misstatement, we need to derive provision for doubtful debts may not have been revised. Provision for doubtful debts may not have been revised to cover increase in receivable days. And hence it may be understated and receivables may be overstated. Inventory days. You see, this is, we are identifying risk of material misstatement by understanding the entity and its environment. Inventory days, if they are increasing, then inventory is staying long in the stock, have more chances of obsolescence. More chances of obsolescence. And it may be overstated. Now, you see here, we are learning how analytical procedure are used to identify risks Risk of middle. Students, you are getting its understanding or not? Are you there? Please. You are with me? Is it clear to you? Tell me, please. I'm not hearing from you since long, more than 30 minutes. Tell me, please. Is it clear? Now, next. The next is current ratio, quick ratio, falling, decreasing, cash balance, low, overdraft increasing, payable days increasing. These all show poor liquidity of the company. These all show poor liquidity of the company. And company may be unable to pay its liabilities to the payables and overdraft when they fall due. And there might be some going concern uncertainty. Which may not have been disclosed in financial statements. Students, ISA 315 is almost complete. Only if I ask you one question, why analytical procedures are performed by auditor? Tell me answer. Tell me, please. Why auditor performs analytical procedures? My question from you. Tell me. Tell me, please. I told you. At this stage of planning, at the planning stage of audit. Yes, please. Any idea? I need to hear from you. I'm not going to proceed further if you do not tell me the answer. Please tell me. Student, this answer is wrong. There are 2, 3 answers wrong. This is correct. That risk assessment. What type of risk assessment? What type of risk assessment? Risk of material misstatement in financial statement, right? No, not trend analysis is not the purpose. Business understanding is not the purpose. The purpose is to identify unusual change in financial statements and hence to identify risk of material misstatement in financial statements. This is the purpose. To identify unusual change and hence risk of material misstatements in financial statements. This is the purpose. This should be clear to everyone. I told it before even, but no one noticed, I think. Now, student, it is done. Now we have to proceed to one small topic. Analytical procedure. There is suitability of analytical procedure. We will talk about that. And then is audit risk only. And after discussing audit risk, I will end the class. Okay? Because this is a lot to you have to prepare before next class. And I'm warning you people, if you come to next class without preparing this lecture, no, I will be a bit harsh with you. I'm sorry to say. Because next class lecture will depend upon today's lecture. And if you sit there in the class without preparing, I'm not saying revising, preparing. Revising and preparing have 2 different meanings. Preparing means that you know everything. And revising in the sense I have gone through the lecture. No. I want to prepare it. You to prepare it. Everything which I am explaining today. Suitability of analytical procedures. So when they are suitable, when comparable information, because analytical procedure is comparison, comparable. This year with the last year, this year with the industry average, this year with the targets. Analytical procedures are used for comparison purposes. Second, auditor expects a little change in figures because auditor knows that this can be the change. If this change is not there, beyond that, it will be unusual change. Yes. And of course, how much detail of information is available. More detail available, more analytical procedure will be helpful. Disaggregation means that breakup. The more details available, more it can be applied in a more convenient way, analytical procedures. Now, it is done. Analytical procedure is done. Now, student, the next topic is audit risk. Yes. Audit risk is the next topic. And let us proceed here. What is audit risk? The risk that auditor may give inappropriate audit opinion on financial statements. For example, auditor says that financial statements give true and fair view of the company affairs, and actually they were not giving. This is the risk. An auditor wants to reduce this risk to an acceptable low level. Yes, audit risk cannot be zero because auditor work has so many limitations. Judgments are involved, sample-based testing is done, and audit work is done after the year end. You know that. Now, yes. So students, audit risk. So how auditor wants to reduce? I said it cannot be eliminated because of judgment involved, sample-based testing involved. So audit risk, because it is quite a situation of embarrassment and even legal matter for auditor. That the opinion which auditor gives, that proves to be wrong. Isn't it a situation of embarrassment for auditor? Tell me, isn't it? It will be. So students, auditor wants to reduce this risk to an acceptable low level. How? So there are components of audit risk that need to be studied. Now tell me one thing. Tell me one thing. You are traveling on roads. The road has, there are so many littering done on the road, and there are so many patchwork also required on the road. You know, road is quite rough. On the other hand, the road is clear, patchwork done, it is repaired. Where the accident chances are high, even you are expert driver, where the road requires work. If God forbid you face an accident on the bumpy road, you know that you yourself are responsible for that accident? No. Yes, you are to some extent, but the road also contributed, road condition. Similar is case with the financial statement. Risk of material misstatement in financial statements. If financial statements are containing so many misstatements, it is just like a bumpy road and driving on that. So audit of such financial statements. So higher the risk, higher will be audit risk. An auditor cannot do anything with this. You being a driver, you cannot do anything to the road. This risk is because of management's work. Auditor cannot do anything. With it. Auditor can't do anything with it. Yes. Cannot decrease it, cannot increase it. But this is causing risk for auditor work. And financial statements are misstated because of two reasons. One is called nature of item recorded in financial statements. Some items are more risky nature. For example, complex items, where judgmental items, so that risk of material misstatement in financial statement, risk of material misstatement in financial statement due to nature of item recorded in financial statements, that is called inherent risk. It is a sub part of risk of material misstatement. It is a sub part of this risk of material misstatements. And second, control risk. What is control risk? Risk of material misstatement in financial statement due to weak controls, inappropriate controls. Yes, weak controls, inappropriate controls that is called control risk. Again, it is related to financial statement and misstatements in financial statement. Again, it is due to that. Now, second component of audit risk, that is detection risk. What is detection risk? Now you see, this risk is not because of auditor. It is because of management. This all is because of management work. They are recording, they are implementing control, and their system is weak. Controls are not working, hence items are not being recorded properly. Detection risk. Yes, auditor is unable to detect material misstatement in financial statements. Now, this is because of auditor. You can note down above it. This is because of auditor. Auditor can manipulate it only. For example, it is a new audit client. We are auditing a company first time. We don't have knowledge. We may not be able to detect misstatements. We need to work detail, get more information. Client is spread across multiple locations. We cannot visit all locations. Problem is there. This is audit risk. So hence, there is a risk model. What is this model? Audit risk is equal to risk of material misstatement into detection risk. And we know that Risk of material misstatement has control risk and inherent risk. Inherent risk into control risk into detection risk. Here it is. Now, students, let us go to the course plan. So audit risk is done. In the next class, I'm telling you, we will be moving to answer drafting. And answer drafting and practice questions along with that. So I suggest to you, please, we have to do minimum 2 past paper questions. Let me give you some home assignment. Page number 17. Yes. From page number 11 to 17, you need to prepare well. Let me write it here. Your home assignment. Homework. Page 11 to 17. Prepare well. One thing. Second, I will give you some questions which you have to read at home before coming to. And one more thing, sorry, which you have to read. That is group audit topic from here. Yes, page number 19 to 24. Page 19 to 24. Read and go through. Just know the difference. And third questions I will give you. You have to read the questions only. Scenarios. Okay. Question number 1. That will be good. Okay. Want to solve some big scenario. Yes. Question number 1 and question number 5. At the end of this handout, they're present. Question number 1 and question number 5. You have to read scenarios at home. In the next class, I'll be solving these 2 questions. And then I will give you some. Remember, our test is coming. Don't forget. This is done. 23rd, then business risk. And practice, and then test. Please, student, do not ignore. You see, I am moving ahead of my plan. Tell me, today's lecture, the conceptual clarity, how much is clear? Tell me out of 10. Clarity about the today's lecture. Out of 10, please. Tell me. Waiting. You have to rank today's lecture out of 10. 10 are the full marks. Good. Everyone, please. Some people are sending me direct message. You can send me direct, but you know, it's not something like that to be having any shame. Yes. Yeah, reading is very important. Reading is very much important. Everyone, please. Rating is important. Rate it. Good. So, of course, I'm not asking you have to read it yourself. I'm talking about my job, what I have done today. Okay. So students, we will be meeting in the next class. But I am warning you again. Please don't come unprepared. What I have said, because it will disturb your studies. Okay. So thank you. God bless you. We have done our task. See you next week. Goodbye. Goodbye. Thank you. Goodbye.